Welcome to the Deep Dive, where we take your source material, the press releases, the presentations, the Q&A, and distill it down to pure, actionable insight. Today, we are diving deep into the Q2 Fiscal Year 2026 earnings call for Casey's General Stores, Inc., ticker CKSY.
And this quarter, it really presented a fascinating puzzle for the market. Management delivered a significant earnings and revenue beat, and then they went and raised their full-year guidance. By all measures, this was just a blockbuster quarter.
A blockbuster, yeah.
Yeah.
Yet, the stock sold off hard immediately after the call.
Immediately.
So that's the core mission of this deep dive for you, the experienced investor. We need to dissect the drivers behind this performance, the inside store momentum, the surprising fuel profitability, the M&A challenges. We've got to figure out why the market focused so intensely on the caution and not the celebration.
Exactly. We'll be focusing on that synthesized narrative, the sustainability of some of these key margin levers, and what all this elevated free cash flow really means for future capital returns. So let's just start with the hard financial snapshot, because the numbers themselves, they were undeniably excellent.
They really were. Casey's reported diluted GAAP EPS of $5.53.
Yeah.
That's a powerful 14% increase year over year. And crucially, it just crushed the analyst consensus, which was sitting around, $5.21.
Something like that. A solid 6% beat on the bottom line. It was impressive.
And the top line was right there with it.
Right in line with that story. Total revenue came in at $4.51 billion, also up 14% year over year, and just slightly beating expectations. But the metric Casey's management really emphasized the most was EBITDA. And that surged 17.5% year over year to $410.1 million. Just double-digit growth all over the place.
So, okay, we have growth, we have a beat, and we have guidance raise, which we'll get to later. But the market's reaction was just a swift punch to the gut. The stock dumped about 5.3% on the day of the call.
And the volume.
The volume was huge. It more than doubled the 3-month average, which signals some heavy profit-taking and pretty aggressive repositioning. What gave the street such profound caution here?
I think it really boils down to this fundamental split screen. You have management on one side showing accelerating results, just pure operational excellence. But on the other side, analysts saw growing structural expenses and a potentially unsustainable, cyclical high in a really crucial margin lever.
So the market's struggling, is trying to reconcile that short-term pain versus the long-term strategic positioning.
Exactly.
Okay, let's unpack the good news first, because the operational execution was, it was flawless. Let's start with that inside store performance. That is Casey's true differentiator.
It is. So inside same-store sales grew 3.3% year over year.
Which is good.
It's good. But what really impressed the analysts, though, was the acceleration to a 7.5% two-year stack.
And that two-year stack is so important because it strips out the noise, right? It tells you the underlying trajectory of customer demand is actually getting stronger.
It's strengthening significantly. It shows sustained momentum, not just some one-off hit. And they did all that while maintaining a really robust insight margin of 42.4%.
And that stability in the margin, even with more traffic coming in, it comes back to their prepared food segment. That's their economic moat.
That's the whole game. Same-store prepared food and dispensed beverage sales comps were particularly strong, up 4.8%.
That's their engine.
It is their engine. Prepared Foods operates near a 59% margin. It's incredible. And management, they highlighted some successful innovation, like the maple waffle breakfast sandwich, which drives that morning traffic.
Right. And then you have their whole pies and hot sandwiches. They're just constantly fine-tuning that high-margin mix.
And it wasn't just the pizza and breakfast items either. The grocery and general merchandise segment that saw same-store sales up 2.7%.
Okay, but what was really crucial there was the margin expansion. It increased by 40 basis points.
And that 40 basis point increase, it was almost all due to a favorable mix shift. So basically, customers were buying more of the higher margin items inside the grocery aisle.
Things like energy drinks, premium snacks.
Exactly. Energy drinks, and especially alternative nicotine products, which, were heavily supported by manufacturer promotions this quarter. So the inside store performance is it's firing on all cylinders, and it's all driven by very intentional mix management.
And that momentum is supposed to drive traffic to the other side of the business, the fuel.
Right.
Same-store fuel gallons sold were up 0.8%. And management made a real point of noting this outpaced the 2% decline seen across the broader mid-continent region?
They did, which means they're absolutely gaining market share.
But this is where the caution creeps in.
This is exactly where it creeps in. The profitability of that fuel segment is what truly stunned the market, and I think it's what triggered the profit taking.
Okay, what was the number?
Per gallon profit was a staggering 41.6 cents.
Wow.
That's an increase of 1.4 cents per gallon year over year.
And this happened even though the macro backdrop was deflationary. I mean, the average retail price of fuel dropped to 2.96 cents from over $3 a year ago.
Yep.
So that margin expansion against falling retail prices is exactly the balance they want, isn't it?
Right.
They're using the inside store to maintain pricing power at the pump.
It absolutely validates their long-term strategy.
Yeah.
Using their rural footprint and that amazing prepared foods offer to insulate fuel margins.
Yeah.
But the market is looking at that 41.6 cents and saying, that's not sustainable.
Right. It feels like a peak.
It feels like a peak. When wholesale gas prices hit 4-year lows, that spread usually tightens up.
Yeah.
So investors are just highly skeptical that Casey's can keep margins this high, especially when their own fuel volume guidance is already pretty flat, pretty cautious. It's -1% to +1% for the year.
Okay, so if the fuel margin is the cyclical high that the market is afraid of, then the expense side is the structural reality that analysts hated.
Yeah.
Let's pivot to those debate points.
Yeah.
Cost and M&A. Total operating expenses increased 16.7% year over year.
Which is a big number.
It's a huge number. Even if you strip out the 10.5% that's due to new stores, same-store OPEX, excluding credit card fees, still jumped 4.5%. That was a red flag.
That was definitely the red flag. I mean, when you're a market darling growth stock, a 4.5% same-store OPEX increase is high. Management's justification really centered on labor. They noted that same-store labor hours were flat, which, effectively ends their multi-year effort to significantly reduce hours.
Then why did they do that?
They said they were prudently adding labor back into the kitchens to support that surging demand, for things like their Thin Crust Thursdays and all the college football pizza promotions.
Okay, but if labor hours were flat, we still need to know where the rest of that 4.5% expense growth came from. Was it higher wages? Was it utility costs? Or were they just spending a ton on marketing to drive the traffic?
It's probably a combination of all of that, but higher wage rates and increasing non-labor expenses like insurance and utilities are almost certainly big contributors. Management is making a choice here. They're choosing to invest aggressively in maintaining the quality of that in-store experience, even if it delays EPS accretion in the short term.
So they're prioritizing customer satisfaction and defending that moat over just immediate expense cutting.
It's a strategic choice, yeah. But it's one the market is currently punishing them for.
Okay, let's move to the second major structural pressure, the integration of all those acquired stores, specifically the CEFCO transaction.
Right.
Casey's now operates 9% more stores. They're at 2,921 total.
And this integration story is fascinating. I think it explains a huge chunk of the market's caution. What's happening is that the acquired CEFCO stores are, for now, significantly lower margin. Management was very frank about it. They said the prepared foods margin at the acquired sites is about half that of the established Casey stores.
Half. That is a massive drag on the numbers.
It is. This lower margin profile at the new sites created an approximate 130 basis point headwind, so a 1.3 percentage point reduction to the overall prepared food margin this quarter.
And this isn't just a number on a spreadsheet. It points to real operational difficulty, right? I mean, these acquired stores, they don't have the kitchens, the equipment, the trained staff.
Or the brand loyalty that supports those 59% margins at a legacy Casey's.
Exactly. So Casey's isn't just flipping a sign on the door. They have to invest serious capital and, more importantly, time to convert these assets into real prepared food destinations.
That's a long ramp.
It's a very long ramp.
Yeah.
Management expects the margin rate to accrete over time. They said rebranding efforts will kick off in earnest at the start of the calendar year, and they're going to prioritize converting the larger stores that already have kitchens first. Those are the low-hanging fruit.
And when you look at the total financial impact of the M&A, the summary is pretty clear. It's helping EBITDA, which is good for cash flow, but it is not yet helping EPS. Not yet. And that drag is driven entirely by the financing. The higher net interest expense, $24.7 million this quarter, is the cost of financing the whole transaction.
Right.
And that short-term drag on EPS is absolutely something the market is pricing into this pullback.
The market hates uncertainty, and it hates delayed gratification.
It really does. But management is clearly trying to demonstrate their confidence in the future, especially with their updated FY26 guidance.
Yeah, let's talk about that raised outlook. They didn't just meet expectations, they significantly raised the bar for the rest of the year.
They really did. The EBITDA growth outlook was increased to a range of 15% to 17%. That's up sharply from the prior 10% to 12% range.
And inside same-store sales are now expected to be 3% to 4%, with that inside margin holding tight between 41% and 42%.
And that confidence, it translates directly into how they're deploying their capital. The board maintained the quarterly dividend, which is, pretty standard, but reflecting the sheer strength of their free cash flow generation. I mean, $176 million generated in Q2 alone, they boosted the share repurchase program.
And that's the ultimate signal of confidence, right?
It really is.
The expectation for share repurchases for the fiscal year was raised to $200 million. That's up from the prior $125 million target. That $75 million increase in commitment to buybacks is a huge statement.
So, okay, if we synthesize all these data points, you can start to understand the sell-off despite the raise. The stock was already up almost 33% over the last year, so expectations were just stratospheric.
Right.
And investors are now focusing on two main risks. One, the sustainability of that 40+ cents per gallon fuel margin. Is that the peak? And two, the patience required for this M&A story to play out, which you can see in the rising operating expenses and that long ramp to get the inside store margin benefit from CEFCO.
But those headwinds are kind of obscuring some incredibly powerful positive catalysts that are coming down the pike.
They absolutely are. First, for future growth, management confirmed the high-margin chicken wings menu test is progressing really well. They've returned to the test stores with expanded flavor profiles, which signals a broader rollout is getting close. That's a huge potential catalyst for the prepared food segment.
Okay, and second, for margin protection.
Right. They successfully hedged 80% of their cheese costs for the next 4 quarters at neutral or even favorable prices.
And that is a phenomenal protective detail.
It's huge. It means that critical 59% margin on their high-volume pizza sales is basically protected through most of the next fiscal year. It just takes inflationary risk off the table for their signature category.
It gives them stability, even as they're absorbing those other structural expense increases.
Exactly.
Okay, we have a full picture. Record execution, a raised outlook, but this deep investor anxiety over cyclical fuel margins and the delayed gratification of the M&A integration. And now we enter our segment. This is not financial advice. Given this short-term dislocation, a stellar quarter, raised guidance, and a big stock pullback, we need a high conviction, maybe slightly outrageous trade idea that exploits this pricing anomaly.
The thesis here is pretty straightforward. It's rooted in the belief that the market is just overreacting to these transient margin pressures and expense growth. They are ignoring the accelerating 2-year comp stack. They're ignoring the protected food margins because of that brilliant cheese hedge, and they're ignoring the substantial increase in the share repurchase authorization.
So you believe this company is executing a long-term transformation?
I believe it is, from a regional champion into a serious cash compounder. And the sell-off, well, it offers a very attractive entry point.
So how do we structure a trade that maximizes our leverage, if we're right, while still acknowledging the short-term volatility the market is obviously pricing in?
We execute a long call spread, and we couple that with selling some downside protection. This definitely requires conviction, but it helps manage the immediate cost.
Right.
The strategy would be to sell a near-term downside put, say, for example, a $500 strike put that expires next quarter. That generates premium for you.
Okay.
And that premium then helps finance a deep-in-the-money call option that expires a year out, say in FY27.
So you're essentially taking the cash you generate from shorting the volatility you think is overstated, that near-term fear, and using it to buy a year of upside leverage.
Precisely. And this is all predicated on the successful, timely rollout of that new high-margin chicken wings menu, and critically, the subsequent margin accretion of the CEFCO stores as those remodels finally get completed. If Casey's hits its new $200 million buyback target and converts CEFCO to that mothership margin profile as they've planned, then the current price in the low 533s represents a highly attractive entry point, validating that whole long-term outperformance story.
A compelling analysis of the trade-offs facing Casey's. So, to recap, they delivered a record quarter with clear beats on EPS and EBITDA, strong prepared food momentum, fuel share gains, and a major boost to the share buyback program.
Yeah. Management is running the playbook perfectly. They're leveraging that defensive rural moat and just continuous prepared foods innovation. The key question for you to explore, given the market's reaction, is this. Can the strong execution and that accelerating capital return narrative, that $200 million buyback commitment, can it overcome macro pressures like falling fuel prices and these structural expense increases fast enough to justify a multiple expansion over the next 12 months?
That is the ultimate trade-off this stock is currently pricing. Thanks for diving in with us. We'll catch you on the next Deep Dive.